Thanks. Hi, everyone. My favorite phrase in English is the future is plural, which means that there are multiple futures at any given point in time, and it's up to us to kind of increase the chances of one of the more favorable futures to happen. So today, I'm going to talk about one version of the risk management future, the future where risk management is less about governance, documentation, and reporting, and more about making ridiculous amount of money for your companies. Risk management that saves millions, reduces time and costs and effort and energy consumption by 90, 80%. You know, something that fundamentally changes the way businesses operate. Not just I think the excuse that we always use that risk management is invisible because we prevent the things that never happen, so nobody really knows whether we actually did a good job or not. I think there are so many things where risk managers actually can do an amazing job and bring physical hard cash savings next month. And it's very tangible and it's very visible. And I wanted to quickly touch on the things that I've been doing. So I'm a head of risk and insurance at one large mining company, and before that I was a head of risk and insurance at one of the largest fertilizer companies in the world, and before that I was the head of risk of a few sovereign funds. And that is my day job. You know, during the day I wear the head of risk and insurance, and I try to share some of the things that worked and discount the things that didn't work. So during the night I put on the other hat, and this is where some of you may have come across my work. Many years ago, 15 years ago, started a YouTube channel, which is now the biggest YouTube channel dedicated to risk management in the world. It's called Risk Academy. I have a very popular Risk Academy blog that has over 1,000 articles. And I disliked coming to physical conferences so much that in 2019 I created Risk Awareness Week, which since then became the biggest virtual risk conference for between 3,000 and 5,000 risk managers all over the world every October. But when IMSA invited me to this, I didn't really hesitate for a second because, well done to the team, and thank you for sponsoring, for supporting this event. What an amazing event. So thank you, guys. For me, this is a rare travel because I do not like to travel into conferences. So all of that knowledge, all of that writing and videos and hundreds of workshops from some of the best risk managers that I now have in digital form available under the risk awareness umbrella allowed me to put all of this knowledge into AI engines and create risk management digital, basically a digital version of myself, which I use in my work, which my team uses in their work, and which is also made publicly available, and outperforms every single publicly available LLM, ChatGPT, Gemini, Claude, you name it, in risk management questions, in risk management task-specific, domain-specific AI tools outperform quite significantly. So that's the little kind of introduction. I wanted to first illustrate an important point on what risk management can actually do. So here's an illustration, a timeline, where something in the past used to cost a lot of money. But that's not the scariest part. The scariest part is the volatility. 1 month it costs 100, the next month it costs 200, and it changes all the time. And if risk managers were a superhero, then our arch-nemesis would be the volatility, because that's what is the biggest danger to the business. That uncertainty, that volatility, that changing from month to month, if it's big, that is actually really bad for business. And you can see that historically, we've proven this over and over again. In the past, volatility was ridiculously high, completely unpredictable, made it very difficult to plan, forecast, budget, and perform. So then a miracle happened. Something happened in the 60s. Since then, not only the volatility increased, but because the volatility decreased, but because the volatility decreased, it allowed the overall cost to go down significantly. And here's another example of the same situation. This is the time, the number of hours the task used to require to perform. So in the past, it was sometimes it took a little time, sometimes it took a lot of time. It was always volatile, it was always changing. And then a miracle happened, and the volatility decreased significantly. Now the task takes predictable amount of time. It's still volatile, obviously nothing is certain in life, but that volatility, reduced volatility, changed our lives. And I'm of course talking about a shipping container. By introducing a shipping container, the ports, the global trade was able to decrease the cost of transportation from $6 to 16 cents. from 8 days shipment to 11 hours. And not only that, it reduced the shipping costs, the loading times, the theft, the damage, insurance costs as the result, and it led to huge growth in global trade. So that's the first message I want you to take away. Doing good risk management reduces the volatility. Reduced volatility introduces significant growth into our industries. And this is, I think, one of the big things that we really need to, A, appreciate more, and B, communicate better. So as a result, lower volatility. So again, none of this is hypothetical. We've done this many, many times before, and I'll share some of the stories on, for example, why Firma in Reims named my team the best risk management of the year a few years ago, and why we're making and saving millions of dollars by reducing the volatility. So lower volatility means more stable, predictable performance. Better and transparent understanding of risks means you can actually price these risks better, because what happens when you don't understand risks, and anybody who's ever tried to insure anything would know that, is that if you don't do a good job at communicating what your risks are, and thank you for the previous mention about the risk program, because that's exactly it. I mean, in my mind, it's a no-brainer. You have to explain your risks when you're trying to transfer them, and I'll talk a little bit about that later as well. Because if you don't do that, the counterparties, they overcompensate. They charge you more, they put more contingency into the calculation, and your cost of capital goes up. And that's really expensive. That's really expensive. Basically, doing business becomes a lot more expensive if you can't prove to your counterparties that your risk management is sound. And vice versa. If you can prove that your risk management is sound, if you can show that mathematically, graphically, physically, then your cost of capital will go down, and that leads to growth. And this is exactly what happened with the global trade. Global trade exploded since we introduced the containers, because shipments now became more predictable. And this is what the ultimate goal is. So in my mind, in my vision of the future of the risk management profession, in my vision, risk management is not about risk reporting, risk appetite statements, risk assessments or enterprise risk assessments, governance, compliance. It's not about that. It's about going from this, and what you see here is a typical monthly cash flow of a company. Every month, sometimes you make more money, sometimes you make less, sometimes your expenses go up, sometimes they go down. There's this inherent volatility in business, which is fine. The problem is if that volatility is A, not understood, and B, is very high. And so we want to move from this world where you have high monthly volatility and sometimes you have catastrophic events, a cyber attack, a fire, a strike, a port congestion, something happens that just throws out your whole business plan. So we want to avoid the tail events being, those highly unlikely but catastrophic events, and we want to shrink the cash flow volatility. So we want to move away from this, which is bad business, to something that looks like this, where we reduce the volatility, we try to exclude the negative effects of tail events, and I'll talk about that. And that will lead to lower cost of capital, and as a result, higher chances of growth. So when I do this in my work, I usually focus on three things. And this is what I believe the future of risk management should look like. We should focus on reducing the consequences of the tail events. And that's basically whatever our insurance team is doing with insurance. We should be insuring the right things. We should be paying the fair price for the insurance. And I'll talk about that in a second. Actually, instead of saying the whole three things, let me just stop on this one and talk about insurance. So insurance is what the insurance team does. Treasury does hedging. And Nicola tells me that Rand is one of the most volatile currencies in the world. I need to double check that, because that's what risk managers do. They triangulate. They never trust a single person or a single company. They need to get 2 more or 3 more opinions. And but if that's the case, there's a lot of effort that needs to be put into actively managing that volatility. And then, of course, everything that the business continuity and the disaster recovery community does, that is also designed to quicken the recovery from whatever unexpected things are happening. So let's quickly touch on insurance, because this is something that is really close to my heart. In 2021, when Firma named our team the best risk management in Europe, and when Reims gave us the award for the same thing, we saved $13.3 million on insurance premiums while tripling our coverage. So we didn't touch our deductibles, we tripled our coverage, improved the quality, so we removed the exclusions that we didn't like and they were not representative of our risk profile, and we still saved a lot of money. And just this year, we reduced the cost of our insurance by, I think we quadrupled our limit and reduced our deductible by 15 times, so 1,500%, and we saved 78% of our cost of insurance. So this is, I think, an opportunity that just sits there on the surface. By better understanding the underlying risk that you're trying to sell and actively selling that risk, explaining why your risk is different from the industry average risk, explaining why your controls and your mitigations actually reduce the chances of adverse events happening and your recovery procedures are better and stronger than the industry average, you can actually present a much more attractive risk profile that insurance companies compete to get and give you a much better price. So this is not a hypothetical. We've been doing this every single year. We're saving a lot of money. And it's a very pleasant board presentation because you just said, you're presenting and you're saying, we've just saved X millions. By the way, that pays for the whole risk department for the next 10 years. So everything we do from now on is a bonus. It's a nice feeling to kind of finally put to rest this concept that risk management is the invisible warrior. Not in my world. We're making physical hard cash savings from last year we paid this year we paid this, but our coverage is also better. So that, I think, is a huge opportunity for risk managers in any organization. I bet, whatever your insurance department is paying for insurance today, you can halve that without any compromises and actually by improving the risk, by better understanding what you actually should be insuring. And by the way, when I joined the company that had a long history of insuring, and I started looking into what were we insuring, we actually found that we were underinsured most of the time. So we would insure a plant for $200 million, but the actual exposure from that plant, including the connection, how it's connected to all the other group plants, was like $1 billion. So we had to increase our coverage to $1 billion because that's what the insurance is intended to do. So I think there is an opportunity there. And it's very tangible, very physical, and not that difficult to do. And by the way, in the time slot that I have, I don't really have an opportunity to kind of deep dive into every single point and explain how we've done that on marine cargo, how we've done it on property insurance, and how we've done it on liability insurance, for example. So, you can find, I'm here for the next 3 days. You can just find me in the break and ask me a specific question and I'll give you a specific answer. The key point is that none of this is theoretical or hypothetical. This is what I'm showing today as the future usually means we've done that 3 years ago and we're going in that direction because we've tested a few different alternatives and this is the one that produced the biggest effect on the cash flow. So the second big thing where I think there is a huge opportunity for the future risk managers is reducing operational losses. And it's looking at the company cash flows and finding those risk consequences that can be improved. It could be fines, unplanned maintenances, excessive use of raw materials, spike in logistical costs. It's a matter of finding what are those things that contribute most to the cash flow volatility. And again, I'm very confident that whatever you find there, whatever is the underlying reason for cash flow volatility, and every company has dozens of them, whatever it is, there's an opportunity for the risk managers to get involved, investigate the issue, and change the business process to make it risk-based to reduce the volatility going forward. It could be in maintenance, in engineering, in procurement, any single business process where you see the biggest volatility, the biggest uncertainty spikes in your organizational cash flow, risk manager can step in and together with the underlying department, figure out a methodology that will save a lot of money. And it's very simple because the bar is very low. I mean, I don't know if you've noticed, we live in the world of volatility. We live in the world of probabilities. So everything is uncertain in our mind, right? Everything the correct word is stochastic. Everything is random. Everything kind of happens unexpectedly. That's not how business operates. If you look at any accounting textbook, any finance textbook, this is how we've been taught, to pick a single scenario and then use that to plan. We plan production targets based on equipment utilization, and equipment utilization is 80%. It's not 80%. It's never 80%. It's always like 65, 75, 85, 95. It fluctuates every single day. Everything in the world fluctuates. It's stochastic. And the businesses operate, we just pretend that the world is deterministic, where there's a single scenario and everything is predictable. And I actually don't know what the situation is in South Africa, but I wonder how your finance departments treat the foreign exchange, whether they use it as a single value or at least in multiple scenarios. But obviously the currency is fluctuating, the interest rates are fluctuating, everything is fluctuating. Every single assumption is actually a range. It's a distribution. So when you look at any business process, when I look at any business process, I actually find that there's a lot of opportunity for saving physical hardcore cash by reintroducing that volatility back into that conversation. And we're doing this right now. We're building a digital twin of our plant, trying to figure out which specific volatilities, which specific pieces of equipment affect our cash flow the most. So we can actually do something to that physical equipment so we can reduce that volatility. And that will make a difference of hundreds of millions of dollars every year by just reducing the volatility. That's the second big thing that we can do. You can reduce the volatility of claims in procurement. You can reduce the volatility of spare parts purchases, of maintenance, of diesel usage, just anything that your company is constantly spending on, it is volatile, and by understanding that volatility and trying to mitigate that volatility, reduce it, you can save a lot of money for your company. And then the final big thing that I'm really focusing on is helping organizations make better choices and reintroduce this concept of optionality. For example, simple choices like, we need to build an extra building in our plant in Brazil. And the simple choice is, do we place it here because it's closer to the other equipment and it saves us costs on the different pipes that need to go to that equipment? Or do we put it across the road in a different location because the location that is near the plant introduces additional fire risk? Because if that explodes, then it will affect the main plant. So everything is a trade-off. In the business, everything is a trade-off. And the chances are, if the risk manager is not present in the room, the trade-off is actually probably not going to consider all the relevant uncertainties. And it could be an emotional trade-off. It could be a trade-off because there is one specific criteria that motivates the team. For example, engineering team, of course they want to build it next to the existing plant because for them it's easier. And for them, the main criteria is we can save money today by introducing this exposure, this risk exposure in the future. But they're not thinking about the future risk exposure because they're thinking about today. Can we reduce our CapEx budget? And this is, I think, where a huge opportunity for every choice, every decision that the organization is making, if there's a risk manager in the room, or if there's a methodology, a process that requires risk thinking to be switched on, then the choices will be significantly better. And there's a whole field of study called decision science out of Stanford and Oxford universities, and Harvard universities, where they have created tools like scenario analysis, like decision trees, like influence diagrams, simple visual tools, not even like hardcore mathematical models that I use. I did a Monte-Carlo budget for my wedding, and my wife loved it. I can tell you that. She really enjoyed that. She was trying to spend the contingency every single day, and I kept saying, no, that's not how contingencies work. So sometimes people go overboard into a very mathematical field. You don't even have to. Some tools that we have in the decision science textbooks, they are available to anybody. And on the next slide, I'm going to mention on how now we live in an even easier world with AI. So the three things that I think will tangibly contribute to your company's success through better risk management is reducing the tail exposure, and that literally means buy better, cheaper insurance, have better business continuity, hedge whatever you can hedge, which is cost effective. Second is introduce this risk thinking or stochastic thinking into the way companies operate. Make your business processes think in ranges. Make your budgets in ranges. Make your maintenance plans in ranges. Make your production plans in ranges. Make your forecast targets in ranges. And then use the proper scientific approach of aggregating the ranges, because you can't actually add different risks together. You actually need to simulate how these risks work. But again, most of this is now done in Excel or even inside AI. AI can now run Monte-Carlo simulations within seconds. So we really have less and less opportunities to excuse ourselves because the technology is giving us all the tools we need. And then the final thing where I think there is a huge opportunity in the future is whenever a company is making a choice, there is always room for risk analysis to understand what is the exposure difference between option A and B and C. And then once you understand that, the concept of optionality comes in. Because most of the time, there's really no right choice. It's a trade-off. There's no situation where one location or one business line or one client is better than the other. There's always some sort of trade-off. One is better but slower. It's the same in the supply chain. Like you can select somebody who's more expensive but they're more reliable, or somebody who's cheaper but they have higher risk. It's always a trade-off. And actually, making an effort to put these trade-offs on the paper and quantifying them wherever possible, that actually makes a huge difference because the this risk-based analysis usually leads to a different conclusion to what the original business proposal was. And it makes a huge difference. And I have lots of stories on each of these points to share if you're ever interested. And so finally, I think there are kind of 3 prerequisites that we need to use to make all of this happen. Because it's easy for me to say, but I've been doing this for a very long time. So I think the first opportunity, and this is, 5 or 6 years ago, I was sitting in my risk profession and I was doing like, what's going to happen? I wonder what's going to happen in risk management that will like truly change, make a difference. Not just to make like a 5% difference, but will make like a 90% difference. What is one thing that will fundamentally change our profession? And then AI happened with everybody's access to it, and that was amazing because now we can actually automate a lot of the tasks that we used to do manually. So for example, when we wanted to save on marine cargo insurance, in the past I had 2 math PhDs calculating for a few months to figure out what is the true cost of that insurance policy so we can actually go back to the insurance underwriters and say, you are incorrect in calculating the fair price. This is our view of the fair price, and this is why we think it's a fair price. By the way, we've done that, and we actually saved $3 million per year on that policy. But in the past, it took months and math PhDs. It's a luxury many can't really afford. Not anymore. Today, ChatGPT literally does the same risk analysis, quantitative risk analysis for me individually as my 2 math PhDs used to do. And I think the irony of all of this is that ChatGPT makes a mistake in almost every calculation. So that's a given. Like it's far from perfect. But it still makes less mistakes than my human risk managers did. And the difference is that ChatGPT now makes this mistake instantaneously so I can correct it. But in the past I had to wait like a week for the calculation, then they come back, I'm going like, this doesn't look right. They go, oh yes, there's a mistake, and then like another week has passed. Now all of this just shrank into a day work to do proper risk analysis. And I think the future of AI adoption is that today I have probably 20 different agents doing specific boring tasks that I dislike. Like for example, I have an agent where I can load an insurance policy and it automatically gives me like 20 red flags that I need to renegotiate because it will expose our company. Or I can load a contract and it immediately picks up on like top 20 risks that I need to discuss with the procurement team so they can renegotiate with the vendor. So today, it's all about creating agents for ourselves to perform boring tasks that we don't want to do ourselves. I think in the future, we will be creating risk agents for other departments, so the procurement team can do the risk analysis before speaking to me. So I hope, in the future, we will live in a world where a lot of the basic day-to-day decision support, decision risk analysis will not have to be done by the risk team, and we can actually focus on much bigger and much more important tasks. So I want the engineering team to be able to just describe the situation, do we build it here or do we build it across the road, and have a good response, good risk analysis for the 2 options so they can make a better choice without me even being present in the room. So I think this is the future, and this is certainly the future where I'm moving towards. And by the way, most of the AI agents that I'm using in my work, I clean them and I make them available for public, and there's like a limited free use every month you can use for some basic tasks, and it's available to everybody. It's called raw at AI. So the second fundamental thing, which I think will change the way risk management world lives, is that we really need a common risk language. Because risk is not really, I think we are mature enough now to move beyond the world where risk is a word, where risk is a description, a flood. Flood is not helpful because you can actually convert that into something tangible. What sort of losses can you expect from floods to your specific assets in your specific location? Or delay. Delay is not very useful because you can't really do much with this information. But if you knew that the delay could be between 7 and 15 days, that you can actually work with. And it's the same for when we were modeling our environmental risk exposure. According to the law, the environmental regulator can stop your production for up to 90 days. But that never happened before. but also it's not 0. So it's not 90, because even though it's 90 in the legislation, this has never happened before. It's not 90, but it's also not 0. So it's actually somewhere in the middle. And with a little bit of investigation, we actually found that on average it's 7, and it kind of goes down from this. So there's like a distribution that you can fit and describe this risk in mathematical terms and use that information anywhere in the organization. So I think the future of risk management, us becoming the custodians of risk information. So if somebody asks, what's the risk of delay? We have that information. We can store that as a little formula, and that formula can be inserted in any business plan, anywhere in the company. It can be inserted into any budget, any forecast, any scenario analysis. We can do the same for the foreign exchange volatility, for the interest rate volatility, for the production volatility, for the equipment uptime, availability, reliability, and recoveries, yields, whatever your assumptions are. Every single assumption can be arranged, and it can actually be represented by a little piece of information that can be used universally across the organization, and anybody who makes a decision, anybody who calculates, anybody who makes a choice, anywhere within the organization, they all speak the same risk language. So a Stanford professor, many, many years ago, and I've been pushing this, I've been trying to help this Stanford professor to get this message across at the Risk Awareness Weeks since 2019, and I don't know, I think we're still kind of not there yet. So if Rima Firma, if you're trying to consolidate all your brokers and all your insurance companies' data into a single place, please use the correct risk language, because this literally, it preserves the confidentiality of the data while keeping the correct mathematical properties. So every time I would ask my brokers, give me the claims data. And every time they would say, well, we can't give you the claims data because it's confidential, because other clients will complain. And I'm saying, I don't need the individual claims, I need the relationship of the claims. I need to understand the loss profile of a particular thing. And that can actually be done in like 15 lines of code. I get what I need, and everybody's happy because nobody shared any confidential information, nobody disclosed anything. So we've had this since like early 2000s. I think it's about time we start using this language as our central database. By the way, this is the language that I use to put in my uncertainties into our budgets, into our engineering calculations, into all our forecasting models, into our digital twins. This is the future of the risk language. And the final message, the final prerequisite is, of course, this culture and risk awareness. So we need people to appreciate that uncertainty is inherent in everything we do, but too much uncertainty is actually bad. So I've started Risk Awareness Week in 2019, and it's been running for the 6 years as a virtual platform available on your phones, your computers. And as part of my really good friendship with IRMSA, I have created a code that gives anybody in Africa full free access to all of the Risk Awareness Weeks, forever. And this is the code for 2025. So please take a photo of the QR code, and that will take you to the page where you can get free access. And just enjoy the lessons from some of the best risk managers I personally respect, and some of the risk managers I learned from. Because what you will be, I hope, not so much surprised about is that they are saying exactly the same things as I'm saying. The future is in reducing the tail consequences, in making the business processes stochastic, and in making proper trade-off choices. And by the way, don't hold on to this code. Like, it's not just for you. Share it with your teams. I send it to everybody in my company, and I'm saying, I don't have enough time for proper risk training, but please listen to some of the best CROs and board members and risk professionals and academics in the world. And it has speakers from all over the world, from Australia to US. So please enjoy that. And let me leave you with the final message. Risk management, in my view of the world, risk management is the ability to guarantee predictable performance in an unpredictable environment. Now, I backtest everything. So I obviously tested this phrase in LinkedIn to my 40,000 followers, and people just went nuts. They hated the word guarantee, because how can you guarantee everything? And we had the whole conversation about this. So this is, I think, one of the important lessons in this. Whenever a risk manager speaks, we always speak at P90. P90 means there is a range between a lie and a truth that is universal and works 100% of the time. And we never speak in absolutes. Whatever I say, whatever number I give, I never speak in absolutes, because that's just a professional courtesy. We do not speak in obsoletes. We speak in confidence intervals. So 90% of the time, I can guarantee certain things, but of course I can be right. Of course there are exceptions to everything, but I just think this is the kind of the mindset that I hope you take through the rest of this conference and when you go back to your offices, because this is what we're what we should be striving to do. We should be improving company performance in an unpredictable world. Thank you, everyone.